This episode of Masters of the Market is proudly brought to you by AIA Health Insurance with AIA Vitality, cover that protects and rewards. To find out more, call 133 AIA or visit aiahealth.com.au today.
Look, to buy when there's blood in the streets, lift up, check under the carpet. Many try but few become master of the market.
Well, Tom Lambeth, thanks very much for coming on Masters of the Market. Your debut for Masters of the Market, but I know there's plenty going on in markets, so really appreciate you taking the time.
Thanks for having me on again. Exciting.
Now, I know you've done a couple of episodes of Talk Your Book before, but you haven't been on Masters of the Market, and there'll be some viewers or listeners that don't know about VP Capital and what you guys invest in. So I thought maybe if you could give us a brief background of what you guys do at VP.
Yeah, sure. So we're an equities fund manager. We have a mandate to basically just grow capital over time by investing in predominantly the Australian stock market, but the mandate's quite broad. So we can look at small caps, mid caps, large caps. Typically, most of our investments are in the small to mid cap end of town, and we can also be long, we can be short. It's really about the opportunity that's in front of us.
And this episode, for the next month or so, I want to have a bit of a focus on portfolio construction and how different investors size their bets. It's something that professional investors like you generally think a lot about, whilst in my experience, retail investors don't often put the same amount of thought into it. So broadly speaking, how do you guys structure your portfolio construction and think about sizing your bets?
Yeah, look, it's a great question. It's an important consideration, I think, for any investor, and many people have different styles. So I think for a few caveats around that, my answer to portfolio management or portfolio construction will be different to another fund manager's view of it, because he may have a different product or a different mandate. As an equities fund manager focused on absolute return, we view portfolio management as being two things. It's growth optimization and risk management. And we think that risk management enables growth optimization. That's the former is the prize. But we need both to work in tandem to have good portfolio management. So why is it important? Because we think that without portfolio management, you can't actually execute on your good stock ideas. So you can either be, to take things to an extreme, you can be too invested in one thing or not enough, or you can be underinvested by not having enough concentration and therefore not being rewarded for your good ideas. So good portfolio management will take into account this and will provide hopefully a good balance.
And you use Kelly criterion pretty extensively in working out how you balance your portfolio. Maybe talk to us about the origins of the Kelly criterion through its gambling history, and maybe explain the basic formula on how that works.
Kelly criteria is very important for growth optimization. We think that it's a useful tool in optimizing, our return on capital in the long run. And as you allude to, Kelly has a long history. It was originally formula, and the original paper was written in 1956 by a guy called John Kelly. He was an engineer. He was actually developing a solution for AT&T to solve a telco engineering problem. But since 1956, it's been used in a range of other activities. And, you mentioned professional gambling. It's been used in blackjack. It's been used in poker. It's been used in professional sports betting. And in the investment world, it's been used extensively, most notably by Warren Buffett and Charlie Munger at Berkshire Hathaway, the great American investor Ed Thorpe, the bond investor Bill Gross. So it's had a lot of history in financial markets. It's got its limitations, which we can speak about. But the simple idea behind it is you can getting back to that problem about bet sizing or investment sizing, what is the optimal amount to invest if you have a good idea? And this formula really gives you a framework to tackle that problem at a high level without getting bogged down in the maths. But the algebra is simply the idea that you have your expected value or your expected edge, and you divide that by what your total upside is, and that gives you kind of a ratio or a percentage to work with to begin to bet size. And that's obviously very important if you're managing a portfolio. You can imagine if you're a professional gambler, that's very important when you're assessing whether to bet on a particular hand of blackjack or not, and how much to bet. If you have no edge, it's obvious to say that you shouldn't bet. That is if the expected value is negative.
So my limited understanding is if you're, let's say, playing a game of blackjack and you're in a situation that says you've got a 60% chance of winning, the formula will say double that, then reduce it by 1, and you should bet 20% of your allocated capital on that opportunity. Is that a very basic layman's understanding in a betting circumstance how the formula works?
Yeah, I mean, like the way that I would look at it is, very simply, let's just say you've got a 50-50 shot at winning a particular hand, and but if you win, you're going to win $10, and if you lose, let's say you only lose maybe a break even, or you only lose $5, then obviously that's a positive expected value outcome, because your return profile is skewed to the upside, and depending on what kind of assumptions you make around that hand, that'll you put the numbers in the formula and it'll tell you to bet a certain amount, and often the number will be double digits depending on what your assumptions are, and so one of the limitations with the formula is it assumes you can realize the outcome of the first hand before you play the second hand, if that makes sense.
Talk me through what that means.
Well, that has its limitations in the stock market, because if you unlike blackjack, the stock market is dynamic, and often you have to have many investments going at once. You can't just realize a particular outcome of an investment thesis after one day or 1 week. The other limitation of it, Chris, is it doesn't account very well for volatility. It accounts for downside risk. So I want to distinguish those two terms, because people often get them confused. But downside risk is accounted for in your expected value assumptions. Getting back to that formula, we're measuring upside and downside and getting to a particular set of odds. Risk is often talked about in terms of variance, and that's what I mean when I say volatility. I guess it does a very poor job of managing volatility. And to your point earlier, you can often be told to put 20% of your portfolio in any one investment, or if you're playing blackjack, 20% of your bankroll in any one particular bet. Now, if you say that to your average super fund manager, they'll probably have a heart attack. 20% is a large number of the portfolio, and obviously that's going to lead to higher short-term and medium-term volatility, which obviously no one wants. That said, if you look at some of the great investors like Warren Buffett, he's got over 40% of his Berkshire Hathaway capital in Apple, in one stock. So it does have merit, but you have to have high conviction. You have to be relatively certain, obviously, and you have to be able to be good at measuring probabilities and odds.
And I'd imagine it's a challenge when you're managing other people's money as well, and there's the risk of redemptions, because like you said, something that's a 50% chance of going a 50 bet, but the upside is 5x and the downside is 1x, I mean, that is a bet you should take every day of the week. But like you say, when you're managing other people's money and there's risk of redemptions, I guess managing that downside before you lose all your capital in that particular investment is part of the art, I guess, that you guys have to implement.
Spot on. And that's exactly why, as I said, no one likes volatility. And that's exactly why we run a version of Cali. It's a framework that we use. It's not, we don't stick to it by the book, because, as you say, no one wants those huge swings that Cali delivers. If you're running private money, then, and you have a stomach for volatility, then maybe. Remember, the other problem here is managing everyone's psychology. You've got the manager's own psychology. You've got investor psychology, unit holder psychology. People make poor decisions when under pressure or clouded by emotion. And the last thing you want is to create an environment of volatility and emotion, because typically you'll make a bad decision. So that reason as well, which Ed Thorpe talks about in some of his papers, is also a reason not to use a full Cali. So you've got to use a version of it, a heavily diluted version. And the way that we get around that problem of managing volatility is we have constraints on the risk side. So going back to what I said for the first principles, Cali will help you optimize growth, but then you've got to have proper risk management in place to make sure that Cali portfolio is appropriately managed and the volatility is managed. And so we, as a rule, we only have 10% of our capital in any one stock as a way to, and we obviously have other principles and rules that we follow, but as an example, that helps us eliminate some of that volatility, because it means that you're never in a situation where you have a large proportion of your capital in one stock.
Does that also mean you end up selling your winners earlier than you would have personally liked?
It probably does, if we're completely honest. And to talk about a stock that you and I have spoken about before, the Reject Shop, that was a good example of perhaps selling a bit too early to manage risk. But it's not perfect. It is what it is. But you try and take the good with the bad. Remember, the idea is you need to get to the long run, and the long run is, Cali is going to serve you very well in the long run, but the short and medium term can blow you up. So you've got to focus on number 2, which is manage risk.
So before we get to that, I just wanted to dig down. I guess the first bit of that Kelly principle that's a challenge for some people is knowing what the odds actually are in an investment. And I guess to start, you've got to be able to have good faith in your valuation metrics to say, well, this is really an asymmetric return profile, and it's not just an even money bet that could double or could go to zero. Is that sort of step one to giving yourself the confidence to implement this formula?
So yes, it's a good point. You've got to be able to be good at picking stocks, and also good or humble about your level of certainty. And those two things are very hard. They're qualitative inputs. There are other models of portfolio theory which you can use, which try and give a more quantitative input. But at the end of the day, it comes down to manager skill, and you're absolutely right. There's no kind of shying away from that. It's garbage in, garbage out, and Cali will be useless to you if you don't have the right inputs, or at least a conservative estimate of what they are. And
so you might have, let's say you've got, I don't know, between 20 and 30 stocks in a portfolio at any one time. Is that around about the right number?
Yeah, we would have anywhere between 10 and 40, where we're pretty flexible about what we have in there, and it really depends on the market opportunities in front of us. But yes.
And so stock X comes across your radar, you do the work on it, you like it. Let's say stock X is at $3. Will you then say, well, we'll buy it at 3. If it goes to 250, we'll sell it. So that's our downside is what, 50?
Not as ruthlessly as that. What we'll do is we'll pick a stock at $3, and let's say we think the upside is 100%, it's to $6, and we think the downside, we think there's a chance we're wrong completely, and the downside, if we're wrong, we think could be 50%. Okay, just on a 1 year view, or 1 or 2 year view. We won't be too reactive about short-term corrections. If the stock's sold off 10-20%, then we'll want to know why that is, and if there's a good reason, then maybe we need to review our investment thesis, which goes to the heart of Kelly. If our investment thesis is wrong, that upside versus downside calculation, then we need to fix it, and that might mean selling. If nothing's wrong and the thesis is intact, but maybe there's a systematic reason behind market sell-off. For instance, some companies were maybe unnecessarily sold off in March. Some were sold off for a good reason, but others maybe were caught up in the wave of things. Then we will most likely stick to our view. Now, it doesn't mean that we won't risk manage if it got to a point where it's all in context, Chris. So if our portfolio is heavily long, and we think we're overexposed to a particular theme or conviction, then we will trim. Or if that theme or conviction is not playing out for whatever reason, then we will trim. But we try not to be too short term about when we change our view.
And so you've got this stock X. You say the downside is 50%, upside is 100%. Let's say it's a 50-50 likelihood that it's going to go to either of those points. So good bet to make. Let's say it's an airline stock. All of a sudden, 3 months later, another airline stock comes across your desk that you really like, that you feel's just as undervalued or even more so. What do you do then when you've already got a position in an airline stock in terms of from a portfolio perspective?
If there's a better opportunity, then there has to be a reweigh. Doesn't make sense to hold on to something that just because we own it. So the answer is it's horses for courses. We will not be stubborn about selling. We will only sell if we think our investment thesis has a problem. But I think you're at the point you're also getting at is around concentration and within the sector. And that's very important because it goes to correlation and risk as well. So we are considerate of that. We have rules around principles around how comfortable we are holding. Let's say we have 30% of our portfolio in airlines. Is that a high number? I would regard that as a high number, by the way. And we would actively try and manage that down to a lower number. But we would to answer your question directly, to substitute within a sector, we can do that, and I wouldn't shy away from doing that. If I can buy a Qantas and I can short sell Virgin, obviously in hindsight. But if there's an opportunity to upgrade our holdings by trimming something else, then absolutely yes.
If you found two stocks in the same sector and the valuation metrics and the upside and downside potential you felt was near identical, would your preference be to take half a position in both of them instead of isolating one?
Absolutely. Yep, absolutely.
And so then exploring that, so many things today feel like they're almost just one trade, like whether it's 30-year bond prices and the way they correlate to tech stocks, and then you could probably put copper in that and various other stocks labelled as the reflation trade stocks. You've got other stocks that are maybe built more for a deflationary outset, particularly sort of precious metals. How do you look at, say, stocks that are correlated potentially, but not in the same asset class, e.g. some of the growth commodities and some of the, cyclical retail stocks or things like that?
You bring up a couple of points. I think on the first one, it's really about the market you're in. And I think your observation is interesting, that everything does appear correlated in some sense. Certainly everything was correlated on the way down in March 2020, wasn't it? And it does seem it was correlated on the way up as well. Certainly growth and cyclicals were. Value became a bit later, but nevertheless, you can make an argument that the market has been correlated, or many stocks have been correlated to each other, I should say. My view on that is having read a lot about some of the history of markets and some greater minds than mine have said that markets often change. You just don't know when, and so it is true they might feel correlated now. That may not hold. So you shouldn't take it for granted. And it's easier said than done, of course, but we should all hopefully have an open mind about changing our view or the way we look at a particular market or sector.
Because even those tech stocks, which intuitively you say, well, they're growth stocks linked to growth, but during lockdown, they became sort of linked to almost a lockdown deflation, similar to gold in a sense, weren't they? So those correlations sort of maybe shifting at this point as well. Is that fair?
Yeah, I mean, you saw Redbubble, Temple & Webster, Afterpay, Sezzle, Zip, anything exposed to online, even bricks and mortar retailers that had growing or online presences like Adairs did very well, surprisingly. But you're right, there was all of those stocks kind of moved together, and that was a change. And then you saw the rotation back into value come really in the last few weeks, and obviously today overnight with the Dow. The Dow was up, the Nasdaq was down, and when was the last time we saw that? I can't remember.
And so when you're looking at your portfolio of stocks, and let's say you've got 30 in there at this given time, do you think through what you think the correlations are at any point in time and how you could get less correlation in there, or how do you sort of view it when you're, from a nuts and bolts point of view when you're looking at your portfolio?
Absolutely, we do. And your more theoretical portfolio managers will tell you that Markowitz, which is the traditional portfolio theory taught at business schools globally, and that's all about the efficient market, and it's all about diversifying away the unsystematic risk, basically adding stocks to the portfolio to lower risk. And if you can add stocks that have low correlations or ideally negative correlations to each other, then you can lower risk of the portfolio even more. So that's been mathematically proven, and it obviously holds. Now there are shortcomings with that, and in principle we do that, by the way. We just
you would sometimes buy a stock you don't. Let's say you rank it as stock number 80, but because it's uncorrelated, it fits into your top 30. Is that something you would do?
Not to the same extent that maybe Markowitz would hope, because as I said at the start, our approach as an equity fund manager at VP is to enable the optimization of growth. It's not to run a risk management book as an end in itself. We only want to use it as a tool to get to a final outcome, which is high quality returns on capital over a long period of time, hopefully. And so the direct answer to that question is no. If we're just adding things that have very poor returns, but maybe have lower risk, then we don't think that's a good use of capital. We're probably better off not doing anything. with our cash, or trying to find something that can offer a halfway house. But it's a consideration. We wouldn't, and I say it's a consideration only. Like if we had identical return payoffs, but we thought that by splitting the risk or splitting the investment over 2 or 3 or 4 stocks, then that's a smarter way to do it. So I'm looking here for ways to optimize growth. I'm not necessarily focused on just putting things in the portfolio that tend to be poor return ideas.
And so when we talk about the sort of Kelly criterion and weighting the bets, and even your view that you prefer to have 2 similar stocks in the same sector rather than one, that sort of mindset speaks to someone with a pretty good win rate and their investments. And there's good investors that might win 50% of the times, particularly in the VC world. They might even win 30% of the time and make a huge return on that, because when they do win, they win 10x or 20x their investment. Is this sort of mindset, using the Kelly criteria and weighting your bets reasonably conservatively, more appropriate for an investor that has a higher win rate?
I think if you have a higher win rate, you've got to look at the total picture. You've got to look at the odds plus the win rate. And the way that I see Kelly, it works so long as you can get to the long run. And the long run.
What do you mean by the long run?
The long run may mean 1,000. To go back to the blackjack example, it may mean 1,000 bets, because the law of large numbers means that, as we know, expected value, equals outcome eventually. So long as you bet enough times to get there. So the problem is, if you don't ever get to the long run, as I said, then you're gone, you're finished. So you've blown up your book. So if you can win 52% of the time in blackjack, then you're doing very well. And providing that you're getting good odds on those bets. So it's not just about frequency of win, but it's also, are you betting on the right things? Just to pursue your VC analogy for a second, the problem with venture capital and Kelly, you don't have arguably enough of a sample size to really test it or allow it to sort of play out to get to the long run. So you may only have 3 or 4 investments per year in a VC, and that's just not enough. Whereas you could play, 1,000 hands of blackjack in a night pretty easily. So you are correct in asserting, Kelly has limitations with respect to some styles. I don't think it's always about win rate. You could have a very low win rate. You could have a 30% win rate, but if you're getting consistently 10-to-1 payoffs on that, then Kelly still might be appropriate.
And talk to me about, before we finish up, just say your ideas around holding cash. Like, you're measured against the index, I assume. Is it a temptation for you to put XX cash in an index fund so it's not underperforming during that time it's out of the market? Or do you really view that cash as just such a nice option to have if markets do tank? You don't want it in an index fund while it waits.
It's more the latter. John and I have a view of, we try not to over-engineer things. Particularly, it's almost a moot point anyway because rates are so low. But we have cash at call simply because we do participate in a lot of primary market opportunities anyway, and we need it there to flush through. So it's more the latter than the former, Chris.
Do many funds keep their XX cash in index funds, or if you're doing that, is it sort of in conflict with being an active asset manager, so they avoid it?
Normally, as an example, the famous short seller Jim Chanos has his fund full of shorts, but he's also long the index with the cash to beta neutral to balance the risk. So there are those examples. I'm not sure whether it would be appropriate for an opportunistic fund such as ours to do that, but because at the end of the day, what you want your cash for is to you want to deploy it when when the prices are good. You don't want to, if you're locked up in the market, then if you take March 2020 as an example, your cash, you're in the market, so you're down.
Yeah, cool. I just always thought that those investors, particularly when they're holding 20-30% cash, that they're so exposed to underperforming the index that they get measured by, to at least take that risk out, and they can still use that other 70 to outperform. I was wondering if that was entered their mindset. But mate, I think we'll have to wrap it up there. That's been brilliant. I've learned a lot, given me plenty to think about. So appreciate you coming on and walking me through the Kelly criteria and how you view risk and maximising your capital.
Thanks very much for having us on, Chris.
For more info on today's partner, AIA Health Insurance, visit aiahealth.com.au or call 133 AIA today. If you're enjoying Masters of the Market, make sure you subscribe to Chris Judd Invest.